Okay, well, we're going to get more on what we should be watching in investment markets this week now with George Lucas from InStreet, who joins us on the desk. George, thanks so much for your time.
Pleasure
First of all, we should start with the Australian market. Everyone, you point out, every man, woman, son and daughter is looking for a correction, and one just isn't on its way, or so it would seem. Where do you see this going now in the near term? Are we going to keep pushing higher over the next couple of months, or are you expecting more of a significant pullback?
We're not really expecting a significant pullback. If you think a significant pullback's greater than 5%, we can't really see that on the cards for the market. You know, over the few months, we're still calling the market at 5,700, but the price action we had during February was quite good. It got the volatility up. It reminded people that it's risky to invest in equity markets, so they can go down, not just go up. But also then February it closed on its highs. So the closing high was also the highest closing level it had in February. So that was all very good price action. March does tend to be a bit of more of a sticky time for markets, but saying that, we can see the market continue to rally, and we're still looking for 5,700 by the end of the year.
I think we're up 1.25% last week. We continue to build on it. Just a quick reminder of why we're seeing these gains. There's three factors you've identified as pushing the market higher, and we'll start with the investment inflows. Everyone's pulling their cash off the sidelines and moving it into equities, it would seem.
Yeah, and it's not just a combination of cash, it's also commodities. So they're doing a quite large sell-off commodities, and we see that in the price of gold going down, because the main commodity, if you look, like $4.5 billion was drawn out of commodity funds in the US last week. Just for 1 week alone, $4 billion of that was due to gold, and the other rest was the remaining of the commodity sector. So you can see that gold is still a lot of selling pressures from fund managers as they switch from gold into equities.
And we're also seeing more corporate activity as well.
Yeah, and that continues, and we see it in Australia here. I mean, it's a global phenomenon, but we see it here in Australia in the higher dividends being announced. And those higher dividends will start being paid. They're going to hit the hands of investors, and investors are going to put it back into the market.
And then finally, the third factor you've identified is central bank movements into the Australian dollar. We know why they like it.
It's the loosening of the monetary policy, and it's generating so much liquidity that keeps fueling the markets. And we see it, so in some ways that sequestered discussion with a bit of a, for the fact that the sequester went through, is actually seen as a slight positive for the market in a perverse way, because it means that the Federal Reserve won't loosen monetary policy. It's more likely that they'll keep it to 2015, 2016, which is what the market's like. And the figures coming out of Europe were probably not as good as expected, and the inflation rate is coming down a lot more rapidly. So there's going to be a lot of talk now that there's going to be a lot more loosening in Europe. Okay. And then we have Japan and Australia, and all of us
and
are
all the meanwhile, our interest rates looking more attractive.
All the meanwhile, our interest rates are looking more attractive.
Okay, let's talk about the risks, because you've identified some of these, as well as to what could stall this rally.
Well, what can stall this rally is what affects those three main factors. And we saw a little bit come out when there was a bit of a fear among investors that the Fed might cut back on their loosening. Yes. But I think the sequester and especially Bernanke, came out very clearly over the weekend and said it's going to 2015, 2016 is going to calm that fear down.
Yes.
Europe always coming back always brings back a bit of nervousness about global growth, and also the numbers out of China would have brought some nervousness around global growth. But I think you've got to remember that the equity markets are looking 12 to 18 months ahead, and the numbers coming out of what global growth is today. And so it'll take a little bit longer for the market to discount those effects in. And then there's, and at the moment, everything in the US is signalling that, business confidence is building, business investment is building, consumer confidence is building, and consumer spending is building. And so the rally in the equity market that occurred there, it seems to have justified what's happening now. But if we start to see those sentiment indicators, especially in the USA, with business and consumer beginning to fall off, the market will take that as a negative as well.
What about volatility? Because it's been pretty low, especially when you look at, for example, the VIX index over in the United States. And you say volatility is actually a good thing for the market. Why is that?
A little bit of volatility is always a good thing for the market, because investing in equities is a risky investment. People shouldn't expect that it's going to go up continuously, and they have to look at building portfolios that are robust so that they can handle falls in the market, because markets do fall, and people forget if there's very low volatility that markets will fall, and then they get very panicky when there is like a 1% or a 1.5% fall in the market, which is not really an unusual thing.
Yeah, investors are a little confused at the moment, I guess. As you mentioned, the cash is coming off the sidelines, out of term deposits, etc. They've been putting it into the high yield space so far. But from your point of view, is that the smart move over the next 6 months or so to continue putting into that space, or has it run as hard as it can, and should they be looking more into the growth space, or is that too risky?
I don't think the growth space, it's very hard because we don't really do that much detailed analysis on it at that level. I think there is still room for the yield stocks to run compared to cash. And I think there's still room for the cyclical stocks to pick up. But at the moment, as you've pointed out, it's been quite a strange rally where the defensive stocks have led the market rather than the higher beta stocks in Australia. And we do expect at some point in time a rotation from those stocks into the higher beta stocks to catch up.
You speak with financial planners regularly. Are they showing any appetite yet, or are they talking about when they might be comfortable jumping into that space?
They are all talking about getting back into the market. Not necessarily they're all pulling the trigger, but they all have clients who are ringing them up and talking about how to get back in the market. Some of them got their clients back into the market earlier on, so they're not looking to add anything, and others are looking at ways to, just using standard techniques that they use, like dollar cost averaging, to get back into the market and get their clients more exposed to the market and out of term deposits.
But still in that safer,
high yielding space. Yeah.
Okay. What about on the other end of things? You speak to financial advisors all the time, but you're also speaking to the big funds. What are you hearing from them that we might find interesting?
Well, I think the main thing from the big funds is that they still haven't deserted the bond market, and so they are looking at the bond market, and that the inflows to the equity market rally is really coming from commodities and cash, and so the inflows from, their bond positions aren't really changing. They might have moved up the curve in risk that they take in the bond market, so they're looking more at the high yielding corporates or the corporate sector and away from the government bond sector, but they still haven't really lost their appetite for bonds at the moment.
So this talk of a bond bubble?
There's really no, I think the talk of a bond bubble, there's no talk of a bond bubble. What they do talk about is the asymmetric risk of bonds. There's really not that much further that they can rally, but there's obviously if interest rates can fall a lot, they can actually have a lot more downside capital risk. So there is talk about that, but they haven't deserted the market yet.
Okay, and we've got an interest rate call from the Reserve Bank tomorrow. Everyone says it'll likely stay on hold. Do you see much of a change in investment markets? Because the calls are so diverse at the moment in terms of the end of the year. We've got some calls at 3.5%. We've got some calls right down at 2% by year end. Is that spectrum going to make much of a difference to investment markets over the next year in terms of which direction they think the Reserve Bank is going in? What would change?
I'm not 100% sure what you mean by the question, but I think the spread just indicates the uncertainty about what's happening, because they're kind of like two camps. You see an equity market rallying, and so the equity market rallying, people think, oh, that's going to start building business sentiment and consumer sentiment. It's going to be one of the main inputs into the leading indicators of what the RBA looks at, and so they're going to see the economy improving a lot sooner than maybe they did 3 or 4 months ago, and so it could take interest rate off the table. And then there's also another camp which really hasn't changed from the GFC days, which is still very negative on the market and really haven't really see the rally, but don't really see what's driving the rally, and they're still in a kind of like a GFC mind with that the whole system could collapse in some ways, and so they look for a lower interest rate. And I think there's this change in two camps developing on the back of a strong equity market rally, which seems to be unexplainable from an earnings point of view. But if you look at it from a weight of money point of view, it does make sense that it's happening.
Okay, just finally want to talk to you about one of the items in the news at the moment, which is two of the big ratings agencies being sued successfully by councils for what they would say would be, I guess, misrepresenting what some of the investments they were making in that CDO space pre-GFC. How relevant is this going forward for investors when you look at these rulings?
Yeah, it's very relevant going forward to investors. I think it was only one rating agencies, and I think that they did find fact against them that they did mislead investors, and I think it was also Grange, who is the investment bank, and they've both had findings against them. Two things have happened. One, obviously, before the GFC, investment banks and product manufacturers worked a lot more closely with the rating agencies than they probably should have when they were coming up with the ratings for the products that these investment banks were putting out. And I think over the last 5 years that's changed, and the regulators have put in a lot more rules in place to separate and make the rating agencies much more independent. But at the same time that that's happening, the whole global economy is, and all the regulation, like so Basel III and the new OTC clearing regulation, relies very heavily on rating agencies. So they're kind of been enshrined into the regulation. But at the same time, the rating agencies are coming out and saying, well, it's only our opinion. And I'm sure if I go to a clearinghouse and I need to put up collateral, they can't say, well, I've rated at AAA. They've still got to want the S&P rating. So you've still got these two things pulling. Yes, they are, you know, a lot of work has been done since the GFC to make them independent, but in some ways they're being enshrined more in the system under new regulations that are coming in for Basel III and the clearing of these over-the-counter derivatives, which is going to require collateral, and it requires the collateral to be rated.
Okay, George Lucas from InStreet, thanks so much for joining us. Appreciate your time.
Thanks.
We do have to take a quick break. When we come back, we'll get some currency calls from Jim Vrondas from Oz Forex. Back in just a moment.